Yes, we've been asked to look at MELI. So I believe that this is like an Amazon type company. Mercado Libre engages in the development of an online e-commerce platform with a focus on e-commerce and related services. I believe it's down in South America, though. I'm actually not seeing the country here. Anyways, I believe it's like basically a South American Amazon. And this stock has done incredibly well over time. In 2007, it was a $32 stock. It is now up roughly 3,800%. So a 38x return on your investment if you bought this in 2007, which is massive. It's ridiculous. So let's take a quick look here at the income statement. So yeah, this thing's revenue has been growing a lot. Back in 2007, it did $74 million in revenue. Now it's done 12 billion.
As well as the costs to produce that revenue, which might be okay.
Yeah. Okay, so even in the let's look at what would 5 years ago would be 2018 now. So 2018 was 1.3 billion in revenue. So they've basically 9x revenue in 5 years. That's pretty impressive. That's actually very impressive. Operating cash flow is going to the moon apparently. It's done 4.5 billion in operating cash flow in the trailing 12 months, which is a ridiculous growth. In 2018 it was 230 million. So that's 20x operating cash flow in 5 years. Stock-based compensation is low. Always love to see that. Looks like it's buying back shares too. It's not diluting. And it does a lot of free cash flow. So that's great. What's the balance sheet look like? You know what? I'm going to go take a look at the insights. Financial health is 3.5. Current ratio is 1.28. Low intangibles. Oh, shares have increased. Okay. Debt to EBITDA is fine. Growth is a perfect 5.0. Revenue is growing. Gross profit, everything is growing super well. Profitability is 3.8. Free cash flow margin is 34%.
Wow.
Wow.
Not as good as Airbnb, but that's really good.
That is ridiculous. That
Someone's
is
saying in the chat that MELI is headquartered in Argentina. Just to add some more color here.
that is crazy, dude. Stock-based compensation as a percent of revenue is low. Operating cash flow low. Free cash flow low. Return on invested capital is high. ROCE is high. Management is operating the business very good, it looks like. So that all looks great, actually. This looks like a pretty incredible company. The free cash flow yield is also almost 6%. Price to free cash flow is only 17. How has it been valued historically? That sounds low. For a business growing that quickly, a price to free cash flow of 17 sounds very low.
And to keep us honest here, Daniel, I'm looking at the about section for this company now on Stock Unlock. They are an online e-commerce platform, mostly servicing Latin America, and they also have a payment solution. So maybe this goes towards what we were saying before, that you're going to have to offer more than just a payment solution to continue to be competitive. And if they are bundling that along with an e-commerce platform, I almost wonder if this is a Shopify competitor. It seems like a few people in the chat may be a little bit more familiar with this business, and we are getting the great moat question here. So I don't know enough about this business to answer that on this live stream, but that is also my next question, because these numbers and growth are incredible.
Yeah, it's also trading right near its historical lows in terms of price to free cash flow and price to operating cash flow. It's like 10% above the lows. So that's pretty wild. That's actually quite wild. If this company can continue to grow as quickly as it has historically, then I mean, it really doesn't look that expensive to me.
It's got 292 stars on Stock and Lock, which is more than I normally see. So definitely a company people are talking about. Yeah, that might be worth adding that one to the watch list and doing a little bit deeper research. Of course, we do not do enough research here for buy or sell. That is up to you. No red flags, though.